Hi everyone and welcome to Kuvera QuickTakes. Our guest today is Rahul Singh. Rahul is the CIO Equities for Tata Mutual Fund. He heads the fund management and equity research teams at Tata MF. He's a mechanical engineer with an MBA in finance from IIM Lucknow and a veteran in financial services with nearly 23 years of experience behind him. Hi Rahul and welcome to Kuvera QuickTakes.
Hi Neelabh, and hello to your visitors.
Thanks. And we'll jump straight away into our question, Rahul. What are diversified funds?
So diversified funds are basically funds which invest across sectors and across market capitalization. So large companies, big companies, it will invest into bank or a pharma company or a consumer company or an infrastructure company. And it will make a portfolio which is very diversified. So it has the advantage of capturing the shifts which keep happening within the sectors in terms of certain sectors doing well versus not doing well. So it has that benefit of going towards sectors if they take a certain view of certain sectors doing better than the other sectors next 2 to 3 years. Similarly, large versus mid cap, I think there are always dynamics which keep changing. So I think the advantage of a diversified fund is it offers you much more opportunities to invest and generate steady returns year after year, and not really, cyclical returns.
Right. So, should diversified funds be part of every investor's portfolio, or should specific segment of investors consider diversified funds?
No, I think it should be part of every investor's portfolio, and it should be a large part. So like I said, sector funds could be 10-20%, maybe quant fund could be 5%, but the remaining 70 to 80, 90% should be diversified funds. I think the advantage today in the market is that while the large caps have done well, the mid cap and small caps have not really done well. So as a category, for example, large and mid cap category as a category of funds or multi-cap category, I think it's an excellent diversified fund to be looking at and to be core of your portfolio, which means 60, 70, 80% of your equity investment should be in diversified funds.
Understood. That's helpful, Rahul. My next question is what are the risks involved, and what are the factors that that investors should understand before they invest in a diversified fund?
So risks are more macro here. See, unlike when you look at sector funds where the risks are specific to a sector, here the risk is more macro. If we have a global recession or a recession in India, then even a diversified fund will struggle to find good ideas. But still, diversified fund would be able to find stocks or companies or sectors which are going to do better even under a slowdown scenario, and which is happening now in the COVID scenario, that there are sectors, for example, pharma, healthcare, IT, telecom, they are doing better than the other sectors. So still you can manage the risks in a diversified fund better. But if there is a global recession, obviously that's a risk. So I would say that the risk is more macro and more economy driven and not necessarily driven by individual sectors.